Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's #2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. I hope you all had a relaxing weekend and have a productive week ahead. Today, US President Joe Biden is in Tokyo, Japan, and we are already getting some big announcements from the visit. Now, we will be discussing these and China's reaction to these announcements in detail in tomorrow's video. But for today, we will be looking at the lockdown situation and the economy. Now, let's start off with the more optimistic or positive news before we move on to the bad news. So, good news first. Nationally, fewer than 5% of Chinese cities are now reporting new daily infections, down from a quarter in late March, according to new data published by Gavikel Dragonomics. This is a Beijing-based foreign firm. Now, this is promising if accurate. The other piece of optimistic news is that with community transmissions largely eliminated, and after almost 2 months of crippling lockdowns, Shanghai continues to inch forward in its efforts to open up and return to something approaching normality. Yesterday, Sunday, Shanghai reopened a small part of its subway system, the world's longest, along with other reopenings of public transportation. The financial megacity of 25 million people at the core of the Yangtze River Delta, the beating heart of the Chinese economy, expects to lift its citywide lockdown and return to a more normal life from the 1st of June. This is about a week away, or so local authorities say. Indeed, yesterday Shanghai authorities laid out the criteria it would use to categorize parts of the city as low risk for COVID as they look to end the lockdown. From June, districts that have not reported positive cases or community infections for 14 days will be defined as low risk. Residents in high and medium risk areas will be restricted to their homes for 14 days until the area becomes low risk. However, Shanghai residents will be entering a new world than the one they left 2 months ago. At a press conference today, Monday, a local official announced that individuals will be barred from entering schools, parks, office buildings, and residential compounds, so basically everywhere if you live or work in the city, without scanning a QR code in the local health app to gain access. According to some surveys as of today, Monday, approximately 60% of Shanghai residents are permitted to exit their apartment and walk around their residential compound. Some people are even permitted to walk outside their neighborhood for a few hours per day. But most people in the city are still restricted to their home or their residential compound. Shanghai has also gradually reopened convenience stores and wholesale markets. However, some parts of the city remain high risk and have recently tightened restrictions affecting millions. For example, restrictions were tightened on Hongkou district on Friday and then Jing'an, a key commercial district, on Saturday, among other places. This showcases the, of course, large remaining risk of future outbreaks across the city and what that will do for business and consumer confidence. Now, moving from one critical city to another critical city, the situation in the capital is much less optimistic than what we're seeing in Shanghai currently. By the way, guys, if you're enjoying the content or getting some value from the video, don't forget to hit the like button. It's a huge help. Beijing has gradually tightened restrictions since the 22nd of April, with many shops closed, public transportation shut down, and millions of residents asked to work from home. Indeed, over the weekend, work from home orders were rolled out or extended for 6 areas, including Chaoyang, Central Business District, and the technology and university hub of Haidian. Yet, despite this month of expensive disruptions, increasingly anxious authorities have struggled to eliminate new daily infections. Indeed, official numbers continue to climb over the weekend, renewing residents' fears of a strict Shanghai-style lockdown. On Monday, today, health authorities in the capital city reported a record number of COVID cases during its current outbreak, 99 cases for Sunday, up from 61 cases on Saturday. While this is low compared to Shanghai, the spike is one of the biggest since the outbreak started, and with large parts of this sensitive capital already under varying degrees of de facto soft lockdown, authorities may feel that they need to turn to the nuclear option to prevent another disaster like we've seen in Shanghai. However, a full Beijing lockdown would put more political pressure on China's zero tolerance strategy and could be almost as economically crippling as the Shanghai lockdown, and maybe worse, since the port city of Tianjin, which supplies and supports Beijing, is also facing a stubborn outbreak. A joint Beijing-Tianjin lockdown affecting 40 million people would be devastating for the national economy and highly disruptive to the logistics chains of the north. It would also take more demand pressure off international energy prices. Up next, the deep concerns regarding foreign investment. But first, one of the reasons why I follow China and its effect on global markets is because I manage my own finances, and I am a big believer in the importance of asset class diversification in unpredictable times like these, whether that is in property, Bitcoin, or a historically well-performing asset class, artwork. Indeed, according to ArtPrice, the value of blue-chip art has outpaced the S&P 500 by 180% from 2000 through 2018, outperforming most fund managers. However, for the longest time, artwork has been an asset class only available to the ultra-rich. That's where today's sponsor, Masterworks, comes in. Masterworks is the first platform for buying and selling shares representing an investment in iconic artworks, making it possible to invest in artists like Pablo Picasso. Masterworks is giving regular folks like us the opportunity to join the ranks of billionaire art collectors and get in on the art investment world. Signing up is super easy. It took me less than 60 seconds. So, if you want to skip the waitlist for some of the most popular pieces, click the link in the description below and see how you can diversify your portfolio with this exciting asset class. We remember that all investment involves risk. Always speak to an investment professional if need be before making any major investment. Once again, a huge thank you to Masterworks for sponsoring this episode of China Update. Okay, up next, the Chinese economy, and we are looking at foreign investment concerns. A major theme that we have been following throughout this Shanghai lockdown period is the question of how this will all affect foreign investment and foreigner presence in Shanghai and China generally. A recent survey by the German Chamber of Commerce found that nearly 30% of foreign employees in Shanghai had plans to leave China soon. It's difficult to know how many will follow through with this, but the rate is high nonetheless, and there are next to zero new people coming in to replace them because of the strict border controls. Foreign business lobby groups have also not minced words in their warnings of foreign labor and capital exodus if COVID controls remain in place. For example, we remember this warning from earlier this month from the EU Chamber of Commerce. Quote, "Many of our members are now taking a wait-and-see approach to investments in China. 23% of our members are now considering shifting current or planned investments out of China, the highest level on record, and 77% report that China's attractiveness as a future investment destination has decreased." End quote. We recall too that American Chamber of Commerce in China President Michael Hart also recently warned of a, quote, "massive decline in investment 2, 3, or 4 years from now," end quote, due to severe travel restrictions on foreign executives and other issues. Chinese leadership appear to be concerned with this risk, as over the weekend, the authoritative state-run People's Daily published a front-page article calling for efforts to stabilize foreign investment in the country. Now, at this point, these are just words, but a front-page story in the People's Daily represents very important words, though it's hard to discern whether the point of the article was to bolster foreign investor confidence or domestic business confidence, or whether it is the signaling of a policy message to political actors. The article expressed, quote, "The policy of stabilizing foreign investment will continue to strengthen, and the efforts to attract foreign investment will be intensified. A more open Chinese market provides more opportunities for the development of enterprises from all over the world." End quote. Late Thursday, too, People's Republic of China Premier Li Keqiang spoke at a symposium with close to 30 overseas business groups, including representatives from the European Union, American, and Japanese chambers of commerce, where he stressed China's huge market and further potential for foreign investment. Li appeared to understand that the foreign business community is deeply frustrated with the current state of affairs, expressing, quote, "We will continue to address everyone's general concerns, focus on solving the problems foreign firms encounter, and provide better services," End quote. Of course, words and actions are different things. The previous day, on Wednesday, at the same event, General Secretary Xi Jinping expressed that China would open its doors to foreign investors. However, with such disruptive COVID policies and signs of impending talent exodus, it's hard to know whether words, even though they come from some of the highest levels of leadership, will be enough to stabilize foreign investment in the medium term. China is indeed a huge market and a historically very popular destination for foreign direct investment. Indeed, in 2020, China passed the United States as the world's leading destination for new foreign direct investment, according to data published by the United Nations. And according to the People's Republic of China Ministry of Commerce this week, or over the last week, foreign direct investment into China rose by 26.1% to $74.4 billion in the first 4 months of this year. However, we may be seeing a fundamental shift in this trend in coming years, especially as the number of multinationals shifting manufacturing capacity out of China to Vietnam, Malaysia, and other countries in Southeast Asia, Latin America, and Eastern Europe increases. Indeed, over the weekend, the Wall Street Journal, in an exclusive, reported that Apple, which assembles over 90% of its products in China, wants to increase production in Vietnam and India and reduce its exposure to China. If we are seeing a shift, will the current COVID restrictions act as a catalyst, is the question that many analysts are asking. Respected veteran economist George Magnus thinks yes. Quote, I think China's support for Putin and the government's zero-COVID response to its own citizens are watershed moments that are forcing people now to review and reconsider consequences and meaning for the business operating environment in China. End quote. A survey this month by the American Chamber of Commerce shows that more than half of the respondents had already either delayed or decreased their investment in China. An earlier EU Chamber of Commerce survey, which we touched on before, had this number at 25%.